Again, CNBC contributor Peter Boockvar, who's chief investment officer at One Point BFG Wealth Partners. So, yeah, I guess, and also, by the way, there's a lot of relationships here. Peter, maybe slammed is too strong of a word. What was your take on the piece, but also what's your take on what Bessent is doing or trying to do?
Well, I wasn't surprised by the content. I was more surprised by the high profile and critical nature of it. And as you said, as they did work together to sort of push back in such a public fashion, I think was a surprise. I think at the end of the day, what Druckenmiller is saying is, the Fed has been trying to manipulate the yield curve since '08 via QE on top of what they did on the rate side. And I think Kevin Warsh even started to say, okay, enough is enough. But then Bessent comes in and tries to bully the long end of the yield curve. The problem with that is the market is much bigger than he is. And Druckenmiller is saying, just let the market price the level of rates that it believes it should go. Because in the piece he said, whenever a government is going to try to fix the price, they're always going to lose against the market. And I think that was really his bottom line. Now, I don't think Druckenmiller was necessarily making a point.
Peter, do you believe that? Because unlike the bond market is massive. I get it. It's global. What happens in Japan matters here. All the stuff we talked about actually just yesterday. But at the same time, the bond market does not have a printing press. We're not talking about doing that. I get it. But you can sell short, buy long. There is a power the Treasury has that maybe the bond market does not have.
Well, in terms of buying power, without the printing press, the market is going to swamp what the Treasury is trying to do. What was clear with what Bessent did is he drew a line at around that 475 level and said, I don't like it here. The market, of course, within a couple of days said they believed otherwise. Now, today we've obviously seen the drop in yield because it's responding to the decline in oil prices. And that's what the long end of the yield curve should do. It should respond to that. And I do wonder, because of Kevin Warsh's relationship with Druckenmiller, whether Warsh sort of disagreed inside his mind with what Bessent did, because Warsh has been telling us prior to becoming chair and after becoming chair that he is okay with the market doing more of the work in terms of setting the cost of capital. And here you come in with Bessent doing what he did. Also, by issuing short-term bills, if he does follow through with this, to finance those purchases, it makes Fed policy even more sensitive to that short-term bond issuance. And that if he does need to hike rates because inflation is still an issue, it's going to be even more cost prohibitive from an interest rate expense perspective for the U.S. government.
Peter, it's Tim. So let's push a little further down this, threes company dynamic that's not, Suzanne Summers and John Ritter guy.
Joyce DeWitt.
But I am talking about Warsh, Druckenmiller, and Bessent. And I almost like Stan Druckenmiller has more credibility than just about anybody on Wall Street. And the fact that these are two former partners, proteges, and the fact that he's really jumped in here against Scott Bessent, the Treasury Secretary, not Scott Bessent, the hedge fund manager. I don't know how to ask this question without forcing you, but does this mean Scott Bessent really is losing credibility, or do you think this is a case where there's an attempt by all three parties to show kind of the independence of the different areas of the government and the Fed?
Well, I'll tell you where I think he could cross the line in terms of losing reputation is if the 10-year yield resumes its upward trend. If it goes to 475, it goes to 480, goes to 485, and Bessent decides to increase the pace of this exercise. And instead of going from 2 to 4 billion, it goes 4 to 8, it goes 8 to 16, it goes even more. And if he decides to push back even more against any market-driven rate move, that is when he risks losing his credibility instead of allowing the market to price where they believe rates should be.